It is my pleasure to introduce our next panel here. It's our investor panel. So the penultimate panel of the day, standing kind of between us and cocktail hour, with maybe a surprise Terry has baked up here. We've assembled a group of rock stars here. I'll invite them to come join me here on the stage. Across kind of a number of different stages of investment. So we've got kind of from the early stage, Edith Yeung from 500 Startups. Mid-stage, Stacey Bishop joins us from Scale Ventures. Kind of that mid-growth stage, it's Seyonne Kang from Greenspring, and moderated today by Tiffany Spencer at Bessemer. So I'll hand it over.
All right. This one?
Yeah, awesome.
So thank you guys for joining us for the Investor Summit. I think it probably makes sense to start, I know we just introduced you quickly, but to talk about a quick overview of your firm's investment profile in terms of where you invest and how you invest.
You're looking
Can we
at
start
me,
with
so
you?
I
Yeah,
gotta start first.
You're the earliest, so you.
All right, so 500 Startup is no longer just 500 Startup. It's 1,800 startups that we have invested in, but it's too late for us to change the name, so we stick with that. We absolutely do super early stage compared to our fellow panelists here. Our average check size is 100K to 200K, and in fact, we run our own accelerator. So what that means is 150,000 for 6%, and we run it, each accelerator, just like a startup schools. We select from 2,000 companies and select anywhere from 30 to 50 companies, invite them in our office to spend 4 months with very specific growth marketing focus. And we end the program with Demo Day. We have Twilio, GrabTaxi, and Credit Karma as our 3 unicorns so far, and we just have a SendGrid as another IPO this past week.
That's great. That's good. I'm Stacey Bishop, Scale Venture Partners. We invest in early and revenue tech companies, so that means like $1 million run rate. So it could be a Series A up to later stage. We typically, typical investment is anywhere from $5 to $20 million check size. And some of our investments, especially relevant to this audience, we were an exec target with Greenspring, Omniture, HubSpot, Demandbase earlier, which was earlier on a panel, and then Box and DocuSign, so a little bit outside this realm. But we like to find those early in revenue, super fast growing companies.
I'm Seyonne Kang from Greenspring Associates, and we have a little bit of a different model. So we have seed and early stage funds of funds, and then we do direct investing at the growth stage. And the companies that we invest in directly, we're looking for about a $10 million ARR, and we're writing checks anywhere from 15 to 25 million on average. And then in some instances, we've gone much higher than that, bringing some of our LPs in with us alongside.
So as you guys are looking at investing in a company, what are the factors that you're looking at, and how do you value team, product, market? Should we start with you?
Sure. So given the stage where we invest, looking for that 10 million ARR revenue level, we are trying to eliminate some of the market risk, and really what we like to say is we're eliminating market risk, and we want to just focus on, at this point, it's execution risk. So I would say team is extremely important. I think that there is a very different skill set that can get, very generally speaking, that can get a company from 0 to 100 million versus maybe 100 to a billion versus a billion plus. And a lot of folks can do it well, but sometimes the team may or may not be the right team that grew it from, again, the early stages through to the growth stages. And then the second thing I would say is, I guess under the product umbrella is, because we're looking for growth, it's very trendy now to talk about platform companies, but as far as your product and whether it can be extended to other areas, that's important for us also.
Is there something specific to the team, since it's so important to you, that gives you comfort, or an immediate red flag? Is the immediate red flag that it's a first-time founder who hasn't gone all the way through?
Not necessarily. I think that there are certain things that you could look at and immediately say that, but we've seen contra examples where it has worked. So I wouldn't say necessarily we would eliminate the first-time founder out of hand for sure. I think it depends. It's sort of a squishy answer, so it's not satisfactory to hear it or give it. But it's a lot about the person and whether they you can see A with the team, either that they've worked together or whom they choose to surround themselves by, or with, I should say. And then the other thing is that, so I read this very good article recently just about founders as CEOs. And there was, I think it's a Bruce Springsteen song. It's like, do you want to be rich or do you want to be king? And I really like that because there are some founders for whom staying as CEO is really what they want to do, and that control is very important for them. And then there are others for whom it isn't as critical, and that they may be willing to make different decisions based on what's important or not to them. And so understanding your founder, your CEO, and where they fall on that spectrum is also really important.
Yeah, and I'll add to that on the first-time founder. In fact, some of our best successes have been first-time founders. So the companies we mentioned, Box, HubSpot, ExactTarget, and Omniture, all first-time founders. But I think the key thing that all those entrepreneurs had, they were all like sponges. They just always asking questions, always trying to get better at things. Also very aware of their weaknesses and knew then how to fill out the team to fill in for those weaknesses. When we've seen founders who haven't made it, it's usually because they didn't build up the team around them to surround themselves with great people, whether it's, they're not great at numbers, get a really strong CFO. If you're a product-focused person, get a really good COO. In HubSpot and Box's case, they both have phenomenal COOs who help with the operations so the CEO can focus on the product. So it just varies, but we've seen great success. And in fact, it's our goal when we invest to try to back the founder all the way. And because when you're investing at our stage and they're on that momentum, if you have to switch out the CEO, usually that's just like just a stop. It kind of, you sort of have to get momentum again. So generally you don't want that to happen. Now sometimes it works where it's a founder, if it's a founder company and they sort of step aside and really embrace that new person, then it can work, but not always. Usually we're trying to back the founder all the way.
And so for scale, when you're looking at a new investment, how do you rank team, product, market?
We actually rank market first because even the best team, if it's not the right market and they can't navigate their way to the right market, forget it. It doesn't matter. So we really look at market first, make sure the market opportunity is there. But then team comes next in terms of their ability to execute against that market or in that market and do really well. So we often see that the best team then kind of becomes the number one company in the given market and then usually gets the outsized return.
So Edith, this is probably very different for you.
Yeah, very different. I think, so recently I have one of my founders call me yesterday, and she was about to get Series A for 10 million. And right at the same time, she also get an acquisition offer. And this is her first time, and she's very, very excited. And 3 weeks ago, we have a different conversation. I said, there's no right or wrong. We're really early. And sometimes our whole mentality is that I don't want only to invest this person for the first time. I want to invest in all the other companies this particular person will start again and again and again.
Especially if she's getting acquisition offers already.
And so sometimes, sometimes people make fun of me because I love learning about all these buzzword investments. So last year I was really into VR, AR. Obviously this is not completely taken off for the consumer side of things, but at least for us, because we're so early, if we're investing in another photo app, it's way too late, right? But if there's I'm really into blockchain, and hopefully I will be able to invest in the best certain market that a lot of the VC may or may not, like a little worry that this may not be proven out. But for us, we want to invest the top entrepreneur for certain market. So there's this Chinese saying that if you're in the right market, a tornado, even you are a pig, you can still fly. This is actually by Lei Jun, the founder of Xiaomi. And I sort of always take that to heart because there's certain things that it's just the right time, right place, the right person. And in VR case, I think we'll have to wait for another 10 years or so. But at the same time, there are a lot of M&As happening. So what we're market first, team. The product is a reflection of the team. But the top two things is what I look for first.
And given how early you're investing, are you already looking at the exit path at that point? Are you thinking, is this a potential IPO down the road? Will it be acquired?
So obviously, no VC want to say that it's okay like for 2 or 3x. It's not okay, okay? At the same time, I think, so we are okay if it's a 30 $30 to $40 million exit because we're so early, right?
Right.
And especially if you come through accelerator, essentially it's a $2.5 million cap. So pretty much like in 3 or 4 months, we can sort of 2-3x that already. So we have very, very different risk profile.
Can I ask a question?
Sure.
So on that
Take
note,
over.
Are you selling into future financing rounds increasingly?
Because
Because you invest so early?
Great question. Been happening more and more. And sometimes later stage lead investor want to buy from earlier investors. And sometimes, but at the end of the day, is really, for the good one, we want to keep it. It's a big dilemma. But for the not so good one, of course. Right?
Hopefully they're not in the room.
And sometimes, recently, there's another case where I really, really like the team, but it's a market that had plateaued. So in my head, I'm like, okay, but there's still a lot of great investors going in. I'm thinking maybe I should sell some. So constantly, I'm going through this dilemma, learning still.
And how about you two? Are you guys thinking exit at the first check writing, or?
I mean, we're always shooting for the IPO, and then if the M&A happens all along the way, and you said, nobody's shooting for the 2 or 3x, but if it happens early in the investment, we'll take it. I mean, in terms of, if it's the right opportunity, I mean, there have been times early in our investment where we've turned down M&A opportunity. It was the right decision, even though it would have maybe even been a 5x or something at the time, because we saw the bigger market opportunity. So a lot determines, what's happening in the market dynamics and where's the CEO's head? Like if a CEO says to me they really want to sell, it's very hard to tell them no, don't, because if they're not behind it, then you don't have something. So a lot goes with what the CEO's mindset is also. Yeah, I mean no one likes to say that, but they'll take it if it's it's whatever 80% IRR. That's good.
But you notice the biggest difference that these guys own at least 10-20% of the company, right? So it's okay. If you think 10% of Uber is okay. Right?
I'll take that.
Actually, 2% of Uber is okay too. but besides that point, most other companies, we own too little.
Yeah.
So that's something that.
Well, and there's also what we kind of think of the concept of the fund model. And the earlier you are, the more you need your returns to be huge, but you have fewer of them. So you'll have more failure rate.
Yep.
As you move across the continuum, we might expect 30% of our investments not to succeed, but we'll hope that 20% of them, get that 10x plus or whatever it is, and then the rest are somewhere in the middle. And the fund model kind of changes as you go from the seed to the growth.
Yep.
Right. And I would say, given, again, the stage where we invest, we are thinking about the exit pretty carefully. But we're indifferent. Well, indifferent. We are, whether it's M&A or IPO is not necessarily a deal breaker one way or another.
So how actively, aside from writing the check, how do you view what you owe your founders after the money? How hands-on are you, and how much are you driving them towards those exits? So if it is an acquisition, are you personally involved in connecting them to the companies that might be buying them and introducing them early, which is something a strategic investor might offer?
Yeah. You might be. And I would say as far as, the different models, you have so many companies, so it's you offer your incubator, and then probably after that you're hoping they get next funding and that next investor comes in. And I think of when we come in, I think of it as, we're there to help whatever we can, but a lot is around financing strategy, just there for the CEO in terms of what they need, team building, if that carries on. So try to be active investors as much as we can, but not dictate what the company should be doing. That's the job of the management team and the CEO.
Yeah, I would agree with that. I'm not sure if we have, when you're talking about an M&A process, those don't necessarily happen not all the time out of, if you're trying to affect it as the company, out of positions of strength.
Right.
So, not really.
No, I think increasingly some of the bigger firms do have days where they're doing sort of biz dev, corp dev. So I think there are different philosophies about how deeply you need to be involved. And I know when I've talked to founders, they generally want the VCs to be hands off, unless it's a moment of crisis. But there's a lot of different philosophies there. I know we're probably getting a little tight on time. So I think one of the things that would be interesting, VCs get a lot of credit for sort of funding the future because we get to see so many things early on. And so I think it would be interesting to kind of talk with the room about what are the trends and the industries that you're most excited about. And I think given the audience specifically, maybe extra credit if it applies to marketing tech and ad tech, even though you guys are all more general investors than specific to that sector.
Okay, I'll start. I think there's one trend that everybody, although this year has been a little harder, but last year, as you guys know, there's two ad tech companies that the first one is Media.net that acquired by a Chinese PE for $900 million, and the second one was AppLovin for $1.4 billion. Mm-hmm. These two major transactions is an indication that a lot of Chinese M&A buyer, and there's also a lot of Chinese investments, and is a trend, and I don't think we have enough time to talk about it, but I think everybody should be aware. Second, I'm really into learning more about and been learning ICOs. And I think that, at least for early stage, I think it's very, very different for later stage. Early stage, I swear to God, at least half of my early stage investments are ICO related. Some of them are not thinking about taking any fiat money. And I found myself have to clarify, are we talking about fiat or crypto on a regular basis? Mm. And I'm reading more white paper than seeing people these days. That's all I can say.
Yeah, that's a whole new industry. But for us, I mean, we're kind of expanding into, we do all enterprise investing, but into robotics and drones and kind of things that, can be, if you think more the Internet of Things, like pushing the intelligence out to the device, that's what we're looking at. But then specifically applying to this, the marketing tech is how AI can affect marketing tech. And I think it was brought up earlier on a panel where it's not AI or machine learning that's doing it all for you. It's, machine learning plus humans. So a recent investment is in a company called Textio, which actually is focusing on the HR vertical to begin with, but it's writing. It's augmented writing for humans using machine intelligence based on the feedback of what's happening. So you can imagine a world where you apply that to sales and marketing and telling the writer which words are going to resonate most with your audience and having that happen real time as you're writing. And I just find that so interesting, and we're seeing that in other areas where it's the machine intelligence augmenting the human behavior in terms of what they should be doing and guiding them.
Cool. Seyonne?
I'd say if there's a sort of a theme of what we're liking right now, I'd say broadly it's the application of technology to traditional industries or traditional areas that have not used tech. So, for example, I think in real estate, you had the Trulia and the Craigslist, that was mostly lead gen. But now you're seeing some companies that are taking what's an incredibly manual process of filling out an app and filling out the credit check, et cetera, and then making it more seamless in terms of, this is more for rentals, not buying, and doing things on a technology basis so that they're not as labor intensive. And then, at some point you could layer on payments, et cetera, things like that on top of it. And then, other areas. One of the most interesting companies I looked at recently was actually trying to apply technology in the farming space. So they're putting sensors on all the tractors and aggregating data across gazillions of farmers and then creating benchmarks, et cetera. It seems so intuitive and obvious what you could do with that data, but you couldn't have done it before, even 10 years ago.
Right.
So again, things like that where it's the application of technology in a way that we couldn't have applied it before is what we're finding is super interesting right now.
All right, I think you ended right on ran out of time clock. So I think everybody will be around afterwards for questions. But thank you.